1999's levels. But we don't believe the long weak cycle is over. Our current situation is somewhat different from Japan in 1987 to 89 and the United States in year 2000. Excessive debt was an ingredient in both of those, but valuations were screamingly absurd. Today, valuations are high, but they're not nearly as extreme. But debt has become a screamingly absurd ingredient today. In the case of valuations in Japan and later in the United States, we pointed out their unsustainability before the markets factored them in. As was the case with valuations in those earlier instances, the current debt situation makes no sense and is also unsustainable. In analyzing the current situation, tonight I'm going to speak a lot about debt and economic issues, but I don't want to ignore valuations. And if you turn over to the next page, I'll touch on valuations briefly first, and then we'll go on to some other things. As Susan indicated, I've got a fairly full program. In fact, I never know when I get up here how long these things are going to take, and so I may have to chop some parts, but I'm going to try to get the most important items out. In any case, on this page 4, the stocks remain expensive. This line represents a ratio. We're talking about stock market capitalization, meaning the value of all stocks, as a percentage of the size of the economy, as measured in this instance by gross domestic income. That gross domestic income typically runs almost identically to gross domestic product, and in the early part of this graph, gross domestic product was used. But gross domestic income is, for all intents and purposes, serves the same purpose here in showing the ratio and the comparisons. The value investors are putting on common stocks relative to the size of the economy over here, that's where it is today, is, at least by comparison with the period since 25, remarkably high. It's not as high as it was in 2000. It's not as high as it was in 2007. But compared to all the other time periods before that, this is a very high valuation. To give you a basis for comparison, this is 1929. This is 1973, right in there. These were, as we know retrospectively, these were major market tops. If you look at the other side of things, when people didn't want stocks, they were not willing to bid them up to attractive prices, these marked the very lows of our stock market history. 1932 down here, 1942 down here, 1974 and then 82 over in these two instances. And interestingly enough, when stocks plummeted so dramatically in 2008, 2009, it only brought this valuation ratio not quite down to even the mid-average level. So as we contended, and have contended quite a while, we took tremendous amounts of value out of stocks. But on a long-term historical basis, it really did not reach the kinds of depressed levels that typically have marked the end of long, weak cycles. Another look at valuation is over on the next page. This compares U.S. stocks with stocks from other major countries, 6 other major countries. We're looking here at 7 countries. Looked at across the line: Japan, France, the UK, Germany, Canada, Australia, and the United States. And we're looking at 4 different criteria here. Up here, we're looking at dividend yield. You'll notice that the United States over here has the lowest dividend yield of any of the 7 major countries' stock markets profiled here. The second one is the price earnings level. And the United States in this instance is the 3rd highest price earnings ratio. So in the middle of the pack roughly, slightly above the middle in terms of high valuation. And then price to cash flow and price to book value, the bottom 2, the United States is the most highly valued. So in 3 of the 4 categories, the U.S. has the least attractive valuation of all of the 7 countries listed here. And in the only one where it's not the least attractive valuation, it's the 3rd least attractive of the 7. With that as valuation background, let's turn to the problem of debt and the government's response to counteract the consequences of debt. Less than 4 years ago, in 2008, 2009, the financial world was faced with the frightening situation of major financial institutions unable to get short-term funding to carry on their basic economic functions. Conditions got so bad that major banks, insurance companies, and automobile companies were bankrupt, so the government bailed them out. With what? With money that did not exist. Government made a promise to collect it in the future from taxpayers. To make those entities even healthier, government dropped interest rates to 0 and gave banks essentially interest-free loans. Do you think that created any distortions? What about the people that the money was taken away from? Those dependent on fixed income returns, especially the elderly retired. Central bankers passed that off as an unfortunate, unintended consequence, but all for the greater good. More recently, it's become Europe's turn. Their banks are now underwater. The European Central Bank has made money available to them for 3 years at a rate of 1% against virtually any collateral they can provide. Are there any distortions in that? Will they be able to pay the money back in 3 years? It's an interesting question, because if they had trouble meeting their obligations now, how likely is it that they're going to be able to meet even greater obligations 3 years from now? Whole countries can't pay their debts. Central bankers have given them money. From where? It's money that didn't previously exist and will have to be collected from European taxpayers and taxpayers in other countries like ours who contribute to the International Monetary Fund. We provide 17% of the funding for the International Monetary Fund. Are there any distortions here? This is the biggest financial bet in world history. We have no precedent to rely on. Unintended consequences are likely. Investors have to decide whether to bet with rescuing governments or with the deteriorating fundamentals that are necessitating the rescues. The next graph shows how aggressive I think you skipped one there. There we go. How aggressive the major central banks have become. This looks at the US Fed, the European Central Bank, the Bank of Japan, and the Bank of England. And without getting into the accounting details, this graph shows roughly how much new money has been created by those 4 central banks since the financial crisis in 2008. We're getting close up in this area of just about $5.2 trillion to a tripling of these balance sheets in less than 4 years. It was about 1.85